Good morning. It's Saturday, July the 29th, and which means it's settlement day for the options that just expired or exercised. As you may know, I sell weekly options generally. Sometimes I'll reach out and leap out a little bit and go 2 weeks. And on rare occasions, I've even gone to a month. But those are very, very rare. In the 15 years I've been doing this, that's probably only occurred a dozen times that I've had to go that far out. So, and that usually only occurs when I just can't get a decent premium at a strike price I can live with. Um, so it's not ideal. The best revenue producer for me is a 1 week contract because I've only got my money at risk for 1 week. And of course, I can get new revenue every week instead of every 2 weeks or every month, whatever. So keeping with that method or tradition, that's what I'm doing today. The rest of the video is going to cover the transaction set that I just closed. Now, the transaction set is a concept or construct that I came up with about 10 years ago to help me see what's going on with this method of revenue production. Because I'm not an option trader. I'm a market maker. I create the vehicle that other people trade. And for that, I get a premium. The only thing I have to do is over the long haul, I have to cover the spread. But I am more concerned with my free cash flow. So whether I'm succeeding or not depends on the number of contracts I can cover and the revenue it produces. Now, since the market went up this week, or at least HBI did, I think with most of the market, it means I've got to choose a higher strike price than I would otherwise like to have. So my choices were to set a strike of 550, which would bring in a pretty healthy premium. But then if it drops dramatically down toward the bottom of its recent trading range, I could have a dollar spread to have to cover. And frankly, if I can't sell $5 puts, I may go to 550. I may cancel this order and go to a 550 strike. I'd rather not do that. So we'll just have to see, which means that if the market and the price of HBI continues to rise on Monday, I may have to cancel this order and place a new one. So if you're following my trades and trying to mimic what I do, you'll want to pay attention to the website Monday because if I have to cancel and place a new order, that happens very quickly. I'll post that on my website right away, but it takes time to produce and upload a video, in which case it might be too late for you to mimic my trade. But anyway, here's the summary or the video of my trades I just placed. And I'll talk about my rationale and you get to see how it's done and, the usual thing. So let's hope we can make some money next week.
When my settled account is 100% cash, that's when I close out the transaction set. There's no reason that I couldn't leave a transaction set open indefinitely, except it would get so long it would be useless. So when I'm 100% cash, that's a good time to start a new transaction set, which I'm doing here. Now the price of HBI has gone up in this recent rally. I don't trust this rally. I'm not sure that in the real economy things have improved very much, but that doesn't mean the market can't defy that logic. So I'm going to take a hit on the number of contracts I can cover because I'm going to have to try to sell $5 puts, and the current market price is above $5. But I'm going to enter the order that way anyway. If this is a true rally and it goes up, then these options will not be exercised, even though the premium received is going to be relatively small. It will be 100% profit if it goes up and not exercised. If it goes back down, then I've still got to cover my spread, which will be determined by what I have to sell what the strike price is for the calls. And so that would likely be a 50-cent spread. So since I'm only collecting, if it sells at 15 cents a share premium, that leaves 35 cents that I've got to receive on the calls in order to break even on the spread. So we'll just have to see how the market goes. But this illustrates one other point that I've tried to make, is that if you need to pull money out of your account for some reason, the time to do it is when the price is down, because that allows you to still cover a lot of contracts, and you don't take this kind of hit. So as the price of the stock goes up, the liquidation value of the account increases, but the number of contracts and revenue will decrease. It's just the nature of the beast. As you can see here on the screen, I'm trying to figure out how many contracts I can cover with the cash available. And I'm letting the order entry process do the calculation for me. I could simply divide the strike price into the available cash and come up with this. I'm being lazy here, and it results in the same thing. Okay, so I want to check to be sure the order is received. So I'll look at the history, and there it is. All right. So that's not as much money as not as much revenue as I would like it to generate. But if the rally is a true rally, then it'll be all profit. If not, at least I didn't jump to the next strike, which would be 550, which could end up being a dollar spread